Hello, today we're going to look at evaluating liquidity. Liquidity refers to the ability of a business to meet its short-term debts as they fall due. Firstly, any assessment of liquidity should begin by analysing the level of liquid funds available. So here we have a firm's current assets. Let's look at the order of availability of liquidity. So usually, if we had to pay off a debt urgently, the first place we would look at would be cash at bank. In this case, there's only $1,000. The next place we'll be looking at debtors control, so we might be asking our debtors to pay us back. Now, stock control and prepayments will be the last place we would look at because it is difficult to control the speed of how you sell your stock. Of course, you could have a sale, but essentially if you really need cash, there's little you can do to control how much cash you can generate with the sale. So for example, if you are selling pots and pans and suddenly you realise you really need cash, you might go back into the store and have a 50% off sale. But imagine if you were a customer walking through a shopping centre and you see a 50% off sale sign with pots and pans, you still might not go in and buy it because you don't want pots and pans, which is one way of seeing how the firm can actually control the sale of its stock. Another one would be prepayments. So if a firm pays 12 months of rent in advance and then they realise they suddenly really need cash, it is almost impossible to go back to your landlord and say, look, can I have some of the rent I paid back because I need it? They wouldn't allow it. We're going to look at the working capital ratio first. It basically assesses liquidity by comparing current assets with current liabilities. As a guide, it should be at least 1-to-1. So here we have the current assets we looked at before and some current liabilities. Using the formula current assets over current liabilities and these figures above, we can see that we have 0.9 to 1. So that means that a working capital ratio of 0.9 to 1 means that for every dollar of current liabilities, there are 90 cents of current assets. So as we said before, we hope there is a 1-to-1 standard. So this is below the 1-to-1 standard, and the business may struggle to meet short-term debts as they fall due. As I said, it's a guide, so they could still meet their debts as they fall due, but they're at a position where it might be more difficult. So looking back, you can see that they have to meet these debts, payments to creditors, GST clearing to the tax office, a loan and wages owing with a given amount of funds. And there's obviously more owing than what they have. Another tool we can use is called the quick asset ratio. It basically compares quick or immediate assets with quick liabilities. As a guide, it should also be at least 1-to-1. So looking at the formula, it's current assets but excluding stock and prepayments, and current liabilities excluding bank overdraft. Looking at the figures we had before, but with the exclusion of these items, we can see that the quick asset ratio is only 0.36 to 1. So a quick asset ratio of 0.36 to 1 means that for every $1 of quick liabilities, there are 36 cents of quick assets. Again, this is below the 1-to-1 standard, and this business may struggle to meet its immediate debts as they fall due. They may not be able to, so it's a guide. Looking back to the formula and linking to what we were talking about before, the availability of cash, we exclude stock and prepayments simply because it is difficult to liquidate these items. So if you're really pressed to repay some immediate debts, essentially you would look at the money you have in the bank and how much debtors owe you. We exclude bank overdraft because bank overdraft is actually an amount, a facility you arrange with the bank. So you might tell the bank you would like to arrange a bank overdraft facility of $5,000 each month. That means that if you do overdraw or withdraw over if you withdraw over $4,000, it's not an immediate debt to repay the bank back because you've actually arranged a facility for them to allow you. So we've taken it out. It's not as urgent as the other items. Now let's look at an example with figures between these 2 years. We can see that we've got bank balance, it's an overdraft, and then in the second year it's a greater overdraft. The working capital ratio is 1.42 to 1, so above the 1 to 1 standard, and by the next year it's increased to 1.45 to 1. The quick asset ratio is 1.07 to 1, so again greater than 1 to 1, but by the next year it's dropped to 0.7 to 1. The question is, explain how the working capital ratio can improve while the quick asset ratio has worsened. Looking at the data, we've actually got conflicting information besides these two ratios. It's interesting how the working capital ratio has actually improved, suggesting better liquidity, but we can see that they've actually got a greater overdraft over the years. So how is that possible? So this might mean that the business has a lot of stock and prepayments, and that explains the increase in the working capital ratio. So they do have more current assets, but these current assets are tied up with stock and prepayments. Now, since the quick asset ratio excludes these items and bank overdraft, this means that the business does not actually have much cash on hand or a debtor's balance. Now, this is evident in the bank balance. It's an overdraft, which confirms that they don't have a healthy cash bank balance. And they may also not have much of a debtor's balance. So since stock and prepayments are difficult to liquidate, the business may struggle to meet its immediate debts as they fall due. Now, using the working capital ratio, we have to realise there are limitations, or there are problems with the working capital ratio. First, it relies on static items. So these items don't change to measure future cash flows. So for example, we're looking at, what the debtors they have on hand, the bank balance they have on hand, the stock they have on hand. These things are what we have now, and we're using what we have now to predict what's going to happen in the future. So it's not very reliable. The next thing is, therefore, it doesn't really provide a real indication of the cash flows of the business. And secondly, they are historical figures, which means that they are from the past, and we're using what we have from the past to predict or determine future cash flows. So we have to be aware of these limitations. Lastly, to overcome those limitations, we have something called a cash flow cover. It's basically just focusing on net cash flows from operations, the most important cash flow, over average current liabilities. So this means that it assesses the liquidity by identifying the actual cash that the business generates from its operating activities to meet its debts. We don't look at this indicator as much, but it is still really important to know. It measures the number of times average current liabilities can be covered by using a net operating cash flow. So the greater the cash flow cover, the more able the business is, the more cash it has to cover its current liabilities. Next lesson, we're going to learn about the speed at which liquid resources become available. That's all for today. Thank you.